if you're putting together a real estate syndication or any kind of syndication or fund, one question you may have is, can you get a bank loan on that property or whatever those assets are at the same time as raising money through equity from your investors? We're going to go through that. My name is Tilda Moschetti. I am an attorney with the Moschetti Syndication Law Group. We specialize in Regulation D, Rule 506B and 506C syndications, and helping syndicators like yourself put together those offerings. Can you take traditional financing while you're also putting together a syndication? The answer to that question is yes, you can. So as part of your analysis of certainly the bank or whoever that lender is going to get paid back first, right? So first and foremost, they always get their money back first. All of your investors need to come second to that. So they need to know that you're going to be taking that financing. So first off, you need to disclose it. Make sure that they know. Now, in order to get that financing, the banks typically are going to ask for a guarantor. Now, if it's a non-recourse loan, so a loan where they can't go after the borrower for anything like, as part of a foreclosure, then they still are going to need a guarantor and what they call bad boy carve-outs or carve-outs. And those are saying that in the case of fraud, of course, they can still go after that person. So they still need a guarantor for that limited scenario. For a traditional loan where it is a recourse loan, which currently is the vast majority of the loans, are recourse loans, they will still require a guarantor. That guarantor is typically you, the sponsor, or it could be some other person that's somehow affiliated with the investment vehicle itself. Sometimes what syndicators will do, if they don't have the financials to be able to qualify as the guarantor, is they will pay for a guarantor from one of the investors. And they do this by offering a finance fee. So they charge a finance fee of maybe 1% to the entire investment, and that money gets sent over to gets paid to the guarantor, one of the investors, so that they get compensated for the risk level that they're taking on. The other thing that banks will oftentimes require is they want to know that there is no one in part of the syndication that owns more than 20%. Typically it's 20%, but I have occasionally heard about it at 10%. Most of the time it's 20% is what the underwriting requires. If anybody owns more than that, then they need to sign on the loan itself. Typically, we don't disclose names to the banks of all of your investors, and so if somebody is going to own more than 20%, they need to know that they probably will have to have their name disclosed, and they will also have to sign on the loan. So, in short, the quick answer is yes, you can use traditional financing, hard money financing, all those different vehicles in order to raise money, raise additional capital for the purchase of assets for your investment vehicle itself. My name is Tilda Moschetti. I am an attorney with the Moschetti Syndication Law Group. We specialize in Regulation D, Rule 506B and 506C offerings, helping put those offerings together for real estate syndications, businesses, anybody who needs outside investment in order to raise capital from outside investors to make those asset acquisitions possible.